Hey team, so there's been a lot of noise in the media and the marketplace this week just in relation to some of the updated changes that the federal government has made in relation to things like negative gearing, capital gains tax, investing in trusts and so on and so forth. And so what I wanted to do is just record a quick video just taking you through exactly what those changes mean, not for the mass market, right? We're not part of the broader property investment market. Some of you are and some of you will be impacted by this. But generally speaking, the way that we invest at Viva is very different. If anything, what's happened is the government has handed us a golden ticket. Well, maybe not a golden ticket, but what they've said is that the things that you do at Viva, guys, is just business as usual, okay? Nothing really has to change for the approach that we have towards property. And so if anything, what's happened is that this week the government, federal government, has validated the approach that we have at Viva and the approach that I and many others have had for years and years and years. And that is that we go out, we buy established homes, we add value to those homes through the form of subdivision, renovation, maybe a bit of construction, some development, house relocation, whatever it is, right? Like if you're adding value, you're seen to be in the business of real estate. And so you're taxed differently. You're not investing for a long-term hold where you're offsetting negative expenses. So where your income doesn't meet your expenses, you've got a negative cash flow event. You're not offsetting that against personal income. You're effectively going out there, adding value to property, trying to make a profit, and you're paying tax on that profit. In some cases, the really smart ones, they go and create more housing supply. They make a profit, but rather than then selling off all of that stock that they've created, they go and refinance it, draw out their equity. They don't pay any tax on the profit whatsoever. They don't pay any tax on the equity, and then you roll that into the next thing. That's what the smartest guys are doing, okay? And so, yeah, what I wanted to do in this video was just take you through what some of those changes actually mean for you personally. So let's just start with the negative gearing, right? So negative gearing is essentially a tax strategy that is taught to the accountants of the world that then gets passed on as advice to their clients. So for people that are typically on higher incomes, they're looking at their tax thresholds, and look, we've got very low tax thresholds in this country. By what I mean by that is that you've only really got to hit $180,000 per year in income and you're all of a sudden in the highest marginal tax rate. And so typically people that are earning high incomes, they want to try and offset some of that using tax deductions, and negative gearing is an efficient way to be able to do that. The problem with negative gearing in this country is that it's a strategy used for people that don't necessarily have high incomes. And so the nurses, the teachers, the tradespeople, the bookkeepers, they're going out there and they're buying maybe one or two properties. They're using the negative gearing effect of that to offset some income tax, but essentially they don't have a lot of tax to offset. So what ends up happening is a lot of the cash flow or the net surplus that they might have that's left over at the end of the month actually goes into supporting the property portfolio. And so really negative gearing is a useful tool for people that are, driving around in a red Ferrari, they're a neurosurgeon, they're an anaesthetist, they're high income earners that really severely have a big tax problem, personal tax problem. But for the rest of us, we should be really approaching property a lot smarter than that, right? So we don't want to be doing negative gearing. Now, what this means is effectively that anyone that has bought a property in the past that's negatively geared, that's been using that negative gearing to offset income, you can continue to do that, all right? So they've drawn a line in the sand and said, look, as of Tuesday, you're no longer going to be able to buy established homes, established properties and get that negative gearing benefit. But for everyone else, you can continue, because it would be pretty bad if they went back and said, if you've bought a property 10 years ago that you've been negatively gearing, you can no longer do that anymore, particularly when they came out at the last election and they were banging the drum, we're not going to touch negative gearing, we're not going to touch capital gains tax, and Albo has repeatedly brought this up time and time again and been questioned about, no, we're not touching, we're not tinkering, we're not doing anything with it. And then sure enough, budget comes out and they've completely changed negatively gearing and capital gains tax and how they get assessed. So you can understand why a lot of people would be frustrated about that, particularly even off the back of COVID. Interest rates were at all-time lows. RBA saying we're not going to touch interest rates for 3 years. We're not going to touch the interest rates. and then all of a sudden we have 13 interest rate hikes in a row. So you just can't believe the government, you can't believe these politicians. They lie through their teeth. All you can do is work with what you've got in the moment and ultimately make decisions based on what you've got at hand. Now, in this case, you're probably sitting there thinking, okay, well, I've got negatively geared properties in my portfolio. Does that mean now that I should keep these properties because I'm never going to get the benefit again? And my answer to that question, because I've already been asked this question multiple times, people in the DMs on Instagram, people in the community as well, my answer to that question is, well, nothing changes for you from what I teach in the program. So what I mean by that is that you still want to be approaching the opportunity cost tool, analysis tool. You want to be inputting the information. You'll be going and finding your average annual capital growth rates. You want to be finding what your bills and expenses are and what your income is, and finding out if there's a negative gearing element to it, negative cash flow that's costing you to hold that property. We want to look at the last 10 years of history and want to use that next 10 years to determine somewhat of what the future might dish up. Not to say that it's going to be accurate, but it's going to give us a bit of an idea. And from there, we still measure, okay, how hard is my equity working? What opportunities are there with this property to add value to it? What opportunities are there to add extra income to this property? I mean, at the end of the day, negative gearing is a very lazy way of investing. It's for the passive holders that want to sit there for the next 15, 20, 25 years and hope that the market does something to the value of their property, and they're prepared to pay for that trade-off, okay? So they pay in the form of propping the property up in the form of negative cash flow. And so moving forward for investors, they're now having to go to new property to continue to get negative gearing benefits. So what does that mean for you? Well, if you think about that, the government is effectively now channeling all that passive investing energy into new housing stock. So where do you want to be on each end of that equation? Do you want to be the one buying it, or do you want to be the one supplying it? I'd prefer to be the one supplying it, right? Being the one that's putting it all together, getting the plans and permits approved, organising the builder, procuring the contract, and actually delivering on these things, because now I've got a really captive audience that's going to have to buy these things if they want to access negative gearing. So they're now going to be competing with first home buyers, they're going to be competing with upsizers, they're going to be competing with, recent immigrants that have come to the country that are looking to settle. So there's now going to be quite a bit of competition around new housing stock. It's going to help add to housing supply, which is going to be good. I don't think it'll make much difference in the form of housing affordability. Okay, housing affordability isn't necessarily just driven by the supply of housing, it's also driven by the supply of credit and the access that people have to credit to borrow to then buy property. And that's more driven by the economic factors of what happens, less about the actual supply of property. There can be plenty of supply coming onto the property. That doesn't mean that it gets absorbed by the market. And so that's the big changes there with negative gearing. So negative gearing up until now will be grandfathered. Negative gearing moving forward will need to be for new housing stock only. You won't get that benefit from established. If you are buying established and you're wanting to get some benefit from the loss, you'll have to accumulate that loss. So it'll be the aggregate of that loss that can then be offset by the time you say go to sell that property. So you'll be able to use some of those losses to then offset the gain. Okay, but that's a delayed gratification tool. So you don't get any of that money that you're physically paying out each month back until you've got to make a decision like selling the property. So let's move on. Next one there is the capital gains tax. So CGT is paid when an asset is sold, with the gain being the increase in value since the purchase. So since 1985, capital gains tax was adjusted for inflation, so it was indexed. We're sort of going back to that way of valuing it essentially, but more so the whole thing is just gone, right? So the discount that you once had, 50% capital gains tax discount for owning a property and then selling it, that's gone now. So you're going to pay a very high tax rate on the sale of an asset, and then that's right up until July 27, right? So the 50% capital gains tax discount would be replaced by the system known as the cost-based indexation, which covers the assets held for more than 12 months. So that's going back to like sort of the previous. The scary thing in all of this is what happens to those pre-1985 purchases, where they now may be assessed for capital gains tax, which previously they were fully exempt, right? Because of when capital gains tax was introduced, that was back in 1985. So that's a big change, right? That would determine when you might sell the property or not. I think that really just puts a big spotlight on when do you do your opportunity cost analysis? When do you make a decision about selling this property or these properties? You've got to take a long-term view here. So if you're not prepared to hold these properties for a very long time into the future so that you don't have to pay that tax, you're pretty much saying to yourself, I'm going to always own this property and it's likely going to be passed down to my kids or the people that are in my will. So you're just going to then go and refinance against that property value as it continues to increase and draw out the equity of it and not pay any tax. But those are big decisions that are going to have to be made over the next little while. The other change which does affect us is the minimum 30% tax on discretionary trusts, which will be introduced from the 1st of July 2028. Now, we've got a couple of years until this comes into effect, so it gives us a bit of time to work out our affairs. However, that is going to change the way that you might structure new purchases. So rather than putting them into a discretionary trust, we've got to look at what the impact might be by holding it in a unit trust or even holding it in just a proprietary limited company. So many of my assets are held in a corporate entity, just a proprietary limited, where they get assessed on the corporate tax rates for trading and non-trading entities. And so I'm going to be doing a session with Sam Chimino from Boss Private on this so that we can really break down what this means for property investors that do own property, not just property as well, businesses, assets, anything that's going to have a capital gain is now going to be hit with this in the discretionary trust environment. So rather than going and doing what we used to do before, which is distributing those profits out to other entities, whether that be personal entities or other legal structures to get the best form of tax rates, now you can be taxed in the discretionary trust environment. So it just takes away a little bit of control. This is really the government coming after the wealthy, the private investment community that's done pretty well, and they're now saying, well, you're not going to have the benefit of moving that money around to get the best tax offset. So those are the big changes that have occurred since the release of the budget that affect property investors. There's obviously many more. We can go through these over the time, but I just wanted to shoot this video to just kind of give you that level of insight in terms of how I see this and how I read this. The big news story is, though, that moving forward, if you're buying property in corporate structures, you're adding value to that property, you're then either selling it and taking a profit and paying tax on the profit. You'd be income assessable because you're in the business of real estate, so it's not CGT assessable. Or you might be keeping some of that property, refinancing it, drawing out the equity, not paying any tax at all, using that to go into your next deal. And then ultimately, the changes to negative gearing and what that might do to the demand side of the supply of new housing and how you can really lean into that to get the most out of it. So if you've got any comments, any feedback, you want to share anything different, if you've got a differing view, by all means, post it in the comments section below and happy to have a conversation about it. What did you think? Are you happy that the government's doing these backflips? I mean, it's pretty appalling from my point of view. You might have a different view. But we are certainly in very interesting times. So there you go. Hope that helps. Bye for now.